What is up, YouTube? Matt McKeever here, and welcome back to the Canadian Real Estate channel. And just thought I'd shoot a quick little video for you guys on interest rates as we head into 2022. We recently, just last week, had the first Bank of Canada meeting where, surprise, surprise, they didn't increase interest rates. And those of you following me on Instagram, you already know that I constantly go on tirades about how I believe they're constantly doves, but they pretend to be hawks. And that essentially, at this point in time, I wonder if central bankers truly believe that as long as they get the headline that we expect to see interest rates rise, that's as good as actually raising those interest rates. So I figured let's do a quick little video today where I'm just going to share a couple of resources with you. I'll also tell you what I'm hearing from fellow real estate investors and how some of them are positioning themselves or kind of pivoting some of their financing strategies because they do expect to eventually see interest rates rise. And it seems inevitable that someday, at some point, particularly as we see, 30-year highs in regards to inflation, we would expect to see interest rates slowly marching in a higher and higher trajectory. But again, I think it's going to be much slower than what you're going to hear from a lot of analysts, what you're going to hear from a lot of central banker talk for sure. And it's for a multitude of reasons. But as we've discussed in the past, literally at this point in time, Canada, all Western economies really, we're just addicted to cheap debt. And I don't think that we can go cold turkey at this point in time. I'm not even sure if we can afford to, ease our way off on the sort of pace that a lot of central bankers are kind of projecting. But that's my opinion. Let's jump into a couple articles first, and then we'll get into what I'm actually seeing from fellow investors. So we'll pull up the screen share here. And a quick reminder, if you guys don't check out Better Dwelling, I think they're one of the best resources available for Canadian real estate investors. And they actually have this great weekly roundup. And so that's really what I'm going to be highlighting with you guys today. So I encourage you, if you don't want Matt McKeever reading you the news, you can just literally go directly to Better Dwelling. But so in their weekly update they had here, obviously one of the first stories is that the Bank of Canada didn't raise rates, but they are quietly adjusting their forecast to show a larger housing contraction. And that essentially is kind of shown or telegraphed through their projections for GDP. Now, again, as we see them reduce the projections on GDP, I wouldn't be shocked to see this used as a justification for why interest rates don't need to rise as drastically as maybe they set out, at the end of last year or the start of this year. But again, we essentially have 8 meetings, right, every year for the Bank of Canada. We've already gone through one with 0 rate hikes. I'd love to hear, what are you guys currently predicting in regards to your expectations for the overnight rate, right? What do you think Bank of Canada will end up doing this year? And again, obviously, there's a lot of black swan potential or, a lot of random events that could occur, whether it's, war and fractions in the Ukraine, whether it's a new variant or something else going on the COVID front, whether it's simply the economy being, ground to a halt because of supply chain issues, whether that's just inevitable or whether that's because of the trucker strike or the trucker freedom convoy protest that we're currently seeing as well. So there's a lot of moving puzzle pieces at this point in time, but regardless of how those play out, personally, in my opinion, I'd be shocked to see more than 2, 3 on the high side as far as interest rate increases. So again, essentially, if we're at 25 basis points right now, 0.25, my expectation on the high end of adjustments would be we end the year at 1%. But again, I wouldn't be surprised to find ourselves actually at 0.75. So more like 50 basis points. But then continuing on from this Better Dwelling article. So another point that I wanted to highlight here was, Canada is saying they're going to use the reverse of a program used to boost housing. So they're going to end the free money train through quantitative tightening. Now, again, maybe they do, maybe they don't. I suspect that they're not going to be quite as bullish on interest rate increases because personally, I think at this point in time, it seems like the stock market is so volatile that if you look at it cross-eyed, it drops. And again, people are much more comfortable with number go up economics than number go down economics. So I think if we did start to see a real correction in the stock market as they're starting to increase interest rates, I personally think we'd see pressure from almost all sides in all directions, really driving a curtail of any sort of hawkish posturing from central bankers. Again, keeping in mind as well that Canada doesn't, exist in a bubble. We exist in a dynamic economy that's impacted by other players. And obviously, the United States, they're going into their midterm elections. I wouldn't be surprised again for them to want to be able to show strong GDP and economic growth under Biden in the hopes of the Democrats, being able to maintain their political power. So again, that's just me kind of putting out a couple theories here. But again, if that was the case, you'd expect them to be a little bit slower on the draw as well, the Federal Bank of the United States. And so if that ends up being the case, again, we expect to see Canada kind of following suit. And there's already discussions that Canada may not be able to march lock and step with the U.S. Federal Bank. So again, time will tell. And we'll find out eventually what the Federal Reserve is up to. But I don't think Canada can afford to step too far out of line. And if anything, we'll probably be a bit of a laggard. Couple other little highlights here. So, Canada is continuing to be more corrupt and seeing more money laundering. This is a subject matter I actually covered in my other show on my other YouTube channel, Matt McKeever Unfiltered. And a reminder, if you guys want to find out my thoughts, my opinions in regards to politics, what's really going on with the Freedom Convoy, about how mainstream corporate press legacy media is often misleading us. If you want to go down that rabbit hole, check out the Maple Pill, and you can find that on YouTube, on Rumble, on Facebook, and we'll leave the political discussions to that channel because some people seem to get triggered when I bring up politics and real estate at the same time. But continuing on here, so again, how much do we really expect the Bank of Canada to raise rates? And I think that we need to understand that it's no longer about sound monetary policy. Not that it ever was about sound monetary policy, but certainly in this day and age where budgets don't need to balance because they magically balance themselves, and other quips that we've heard from politicians and those in power, I think we can continue to expect them to be more dovish than they let on. And again, it's this entire concept we find ourselves in where the headline matters more than the facts. So if you get that headline that makes it sound like we're going to act hawkish, then the market and economy starts to react to that, regardless of the fact that down the road we end up seeing there isn't an interest rate increase. And that's essentially the equivalent in, politics or mainstream press of like a retraction. The headline always gets more attention than any sort of correction or retraction that occurs after the fact. Another interesting headline here is that the Canadian real estate markets have seen a typical home increase up to 400,000. And this is not sustainable in any stretch of the imagination. It's wild that we still find ourselves in this position. And it's not surprising necessarily that we're seeing Canadians really take advantage of it, right? So also HELOC debt just made the biggest jump since March 2020. This could be for a multitude of reasons, but probably one is the fact the economy hasn't bounced back the way that probably a lot of people expected it to, seeing how we're now 2 years into this pandemic. But as well as house prices increase, Canadians continuously look at that more and more like it's their piggyback, their retirement savings. It's essentially this bottomless pit of money, or bottomless pit wouldn't be right. It's this bottomless piggy bank of money. That's probably a better description there. And then again, talking about this was interesting. National Bank came out essentially saying that if Canada skips the rate hike, it's due to the Ukraine and not the economy. I disagree. Again, maybe the Ukraine plays in as a factor in regards to all this. And obviously what goes on in the Ukraine definitely would play into a factor in Europe and Russia. And that could have spillover or cascading effects for us here in Canada. But I find it hard to fully swallow the idea that the primary driver here is the Ukraine. I literally think it's just our economy is so addicted to cheap debt. So many businesses, particularly while they're still not able to operate at full capacity, right, as well as they're experiencing supply chain issues, border crossing issues, all these factors, tourism, all this really does impact the broader economy. And I think also politicians, they really like to see a stable stock market at this point in time. So again, I don't think they've got the teeth or the balls at this stage to drastically go on an aggressive rate hike, regardless of whether the fact that would actually be the smartest thing long term for us, right? We probably should just bite the bullet, get through this pain now, rather than wait until it gets worse, right? The idea of when should you try and improve your health? Well, you should probably just try and improve it today and not wait for a health scare. But let's be honest, most of us are going to wait for a health scare before we start taking our health more seriously. Then switching gears here, but this is another Better Dwelling article. They just did a recent survey where essentially they asked a bunch of Canadian banks and analysts, what are your projections for where rate hikes are going to be? And I found this, this dot graph here to be very illustrative about where people think. So while a lot of the articles and headlines at the start of January made it sound like they were expecting to see a 0.25 increase, the day before, we immediately saw that, oh, no, a lot of people were pulling back on their aggressive projections. And again, while you look at it, it's kind of evenly split at this stage, whether they expect a March rate hike as well. And when we're looking on the further graph, literally the most aggressive, the most hawkish individual that was surveyed here sees us ending the year at 1.5%, which again is a decent bit behind what we originally saw with this article. And I don't know, you guys maybe saw me roast this article on Instagram, but Scotia sees Bank of Canada hiking rates at 2% to quell inflation. Well, that would be smart because, as we mentioned, we're at 30-year high inflation rate. I don't see how they can actually do this. And this came out January 19th, right? So it was obviously before the January meeting, but not that much before. So from the article, Bank of Nova Scotia says Canada Central Bank will begin an aggressive round of monetary tightening next week to control inflation, bring its policy rate to above pre-pandemic levels by the end of the year. Again, I just don't see it personally. The Toronto-based lender is now projecting the Bank of Canada will hike its overnight policy rate to 2% in 2022 from the current emergency level of 0.25, according to a report published Wednesday, shortly after Stats Canada said inflation hit its highest in 3 decades. Scotiabank forecasts the Bank of Canada will make its first move with 25 basis point hike at its January 26 policy decision meeting, which again, that didn't actually happen. That's expected to be followed by another 25-point rate hike in March, a 50-point increase in April, and then 3 more 25 hikes by the end of the year. One thing I feel pretty confident in predicting, even though I understand my crystal ball is just as foggy as yours, but it turns out we're probably just as accurate as most of these analysts at this stage. I don't see a single individual rate hike that's going to be above 25 basis points. It just seems wild in my opinion. And understand now, if you operate under that logic, essentially for Bank of Nova Scotia or Scotiabank here to be on the money with their projections, every single Bank of Canada meeting for the rest of the year would have to see a rate hike. Again, I just don't see it, but time will tell, and we'll see a year from now who's on the right side of history with their predictions. And then one other little thing I just wanted to highlight here from Steve on Twitter is remember how back in 2021, Bank of Canada said they weren't that concerned about the real estate market, and yet we've all seen the results of what actually happened in real estate with some of the craziest price increases we've ever seen. So this is a direct quote from the Bank of Canada. So far, we are not seeing the kind of excessiveness in the housing market that would really get us worried. Macklem said, this doesn't look like 2017. And Steve responds here, newsflash, national home prices are up 26% since this speech. This market is wilder than 2017. Absolutely agree. And again, that was from the January 21st, 2021 meeting. So literally in a year, we've seen 26% interest rate increases, and yet the Bank of Canada is doing nothing. And at this stage, I don't know what's really going to drive them to do it. I think that we could easily see another 20-30% increase in housing prices this year as inflation continues to run rampant, as loose monetary policy continues to have money just sloshing around the economy, and that money needs to find a home, right? And I think that it's going to continue to chase a lot of real estate assets for a multitude of reasons, but one of the biggest ones is the fact that Canadians at this stage, they all just believe that real estate always goes up. Because for the longest time, other than a little blip in 2017 when Toronto condo market didn't necessarily go wild, it has. So literally since I've been investing in real estate since 2010, it's only been up. There was a couple moments where it maybe caught its breath, but we've never seen a significant correction. And understand that means that there's essentially an entire generation of real estate investors that don't know hard times. So a couple of things that I just want to highlight for you guys is one, if you're struggling to make your business model work in this economy, understand that if we see some interest rate increases, if we see some real drastic impacts to our economy, you're probably going to be one of the people that's, proven to be naked when the tide goes out, as they say. So I think it's important that you really start focusing, and you should have been doing this all along, but if you haven't, now's the time to be scared straight and start focusing on fundamentals when it comes to investing. can you afford to hold on to this property over the next couple of years, regardless of what goes on in the general broader economy? If you can't hold on to that property, maybe you should consider taking some profits. And again, that may mean that you end up missing out on some price increases and potential, equity gains. But if you don't think you can hold on to it, and again, understand that we live in as dynamic of a time as ever, if not a more dynamic time. So, right now, most landlords I know have been very fortunate that their tenants have been able to afford the rent. And in fact, when vacancies come up, they're able to drastically increase the rents because there is still such a shortage. Now, fundamentally speaking, nothing's really going to change the demand here as far as rentals are concerned. And as well, when we're looking at like housing supply, we're seeing some of the lowest months of inventory in regards to real estate for sale ever, right? We're in probably the most unbalanced market I've personally ever experienced, where literally, demand is outstripping supply. And like every quarter you think like, okay, we must have hit like a new all-time peak, and now we're going to see it kind of curtail off. That hasn't been the case. And so again, no one can predict the future, but I think it's more important than ever before that you are focusing on the fundamentals. So that means if you're a buy and hold investor that's renting out a property, does that property actually cash flow? Can you actually weather a storm? Can you weather a couple months where maybe you have a tenant turnover and maybe you don't get to raise the rents upon that tenant turnover? Those are questions that you should really be exploring at this stage if you haven't already been doing so in regards to your investment strategy. And it concerns me when I see such aggressive strategies from investors across the spectrum. Now, again, that doesn't mean there's not money to be made. Regardless of what happens in the market, there's always huge opportunities. But I think you need to be going into this eyes wide open and not just assuming that like all I need to do is buy any piece of real estate and next year it's going to be worth 20 or 30% more. Even if that is true, it's not a replicatable business model. And that's one of my pet peeves about individuals that get lucky rather than work hard when it comes to investing. Again, you can get lucky for extended periods of time. The economy, the central bankers, monetary policy can continue to bail out bad business models. But I think that there's a shelf life to how long that occurs. In fact, I would have thought we'd already tapped out that shelf life, but that's not the case. And one other aspect that I've shared with you guys regularly on social media is understand that as things continue to become more unaffordable through inflation, through supply chain shock and things of that nature, we're going to continue to see landlords becoming an easier and more attractive scapegoat for politicians. So you need to start getting involved in policy. You need to start getting involved in politics. Or honestly, in my opinion, 10 years from now, real estate investing is going to look drastically different because there will be all sorts of new taxes. There'll be all sorts of new regulations and rules that they will enforce upon you. So again, that's not to say that that's inevitable. But right now, based upon the lack of involvement from landlords I see in regards to policy, and again, there's exceptions, right? We've got Kayla from the Ontario Landlords Watch. She's doing a wonderful job of highlighting policy issues and trying to help represent landlords and landlord rights. But again, Kayla can't fight that fight by herself. So it's important that, anyone that's a landlord that wants to continue to be a landlord for the next 10 years starts getting involved in those movements, starts making sure their voices are heard, start making sure the politicians realize that it's not just renters that vote, but it's also landlords. At the end of the day, it's important that politicians eventually understand it's their loose monetary policy that's driving this market, not greedy landlords. However, when you're on a stump speech and you're trying to get elected in the next election, it's a lot easier to point and just make out that landlords are this, greedy sub cohort of Canadians, and let's just throw all the blame on them. And again, if you're not careful, if you're not involved with policy, if you're not making your voice heard, I think that we will inevitably see that narrative evolve. So again, those are just my thoughts on the subject matter. You guys let me know what your thoughts are in the comment section down below. And one last thing I just thought I'd share with you. I've been talking to a handful of different real estate investors. You guys probably saw recently we had Casey Wong on the channel, and been chatting with Casey as well as other apartment buyers and just asking what sort of process or what strategy are they currently taking when it comes to financing or refinancing their properties. I'm hearing more and more often now that real estate investors are starting to have a bias towards fixed term mortgages, and particularly looking at longer terms, right? Like 5 years, some are even locking in for 10 years. And really one of the fundamentals that they're using to justify this is the risk reward. So, the risk that you're going to miss out on drastically lower interest rates and we're going to see rate cuts in the future, their mental math, and I don't disagree with them on this, is kind of stating to them that, like, yeah, there's only so much upside there remaining. However, the chance that maybe something drastic does change, and, if inflation really gets out of hand, we're going to we would assume, have to see central bankers step in and start drastically increasing interest rates. And that could impact, landlords, particularly those with variable mortgages or mortgages that are coming up to refinance in the near future. And there's a few things you guys can do. One is just try and spread your risk if you're concerned about risk. And by spreading your risk, again, you can even keep the same mortgages you currently have, but look at staggering them out rather than necessarily having all your mortgages come for renewal on the same day. And again, I understand, or like the same time period, doesn't necessarily need to be the same day, but even coming for renewal all in the same quarter, even all in the same year. Sometimes we end up in these situations where it made sense to refinance your entire portfolio at one given point in time. Oftentimes there can be incentives from your lender depending upon your exact situation. However, understand that there are consequences to that. If you happen to find yourself in a higher interest rate environment and boom, all of a sudden you get hit with a multitude of different properties coming up for refinance, if you can find a way to stagger when those come for renewal, that's one way to try and spread some of the risk that you're experiencing. As well, really run the numbers. How much are you saving by taking that variable interest rate versus looking towards a fixed rate? And what can that property or what can your entire portfolio manage, right? What can you handle? And again, this is all just about doing the due diligence when it comes to being an investor. But I know we're in very heady times where essentially everyone thinks real estate's the silver bullet to becoming rich. And while it's certainly a great investment strategy, again, it's only a great investment strategy if you're doing your own due diligence, you're doing your homework, and you actually understand the fundamentals behind your business model. So appreciate you guys watching this video. See a few people jumping in the comment section here, but I think I'm just going to wrap up for today. Smash that like button, hit subscribe if you're new to the channel, and reminder, we're constantly putting out new great Canadian real estate content. Hope you guys enjoy it. Thanks, guys.